Oh, there.
And we're
Hey,
live.
everybody. Welcome to Cap Rates and Coffee. My name's Jeff Hammond. I'm a senior editor here at Janover Ventures. And Blake, would you like to introduce yourself?
I'm Blake Janover, the founder and CEO, same company.
I'm Joe Nolan. I'm the director of small business here at Janover Ventures.
Brandon Romane. I'm the director of capital markets here at also the same company as well.
All right. I want to say, Jeff, I know you're the boss here. I want to say that this is nerve-wracking. We don't have a plan. We're streaming this live. I did not know that this was sent out to a lot of people, and Jeff dropped the bomb that 40,000 people were invited to this. So I'm having a mild
Don't worry,
anxiety
Blake. I also
attack.
just got a LinkedIn push notification saying we're live. So.
Oh no. I want to formally apologize in advance for the haberdashery. Is that I'm not even sure the context is correct there, but Jeff, I'll kick it back to you.
Oh, thanks. Yeah, it's a bit nerve-wracking for me as well. But one thing we really wanted to talk about, basically with Cap Rates and Coffee, which we just picked the name like a week ago, we're going to be looking to discuss some ongoing things in the CRE space and kind of what we are seeing. So today we had the idea that we wanted to talk about what's going on with interest rates and also maybe talk a little bit about tax, since it is basically tax day today. So who would like to kick us off?
Well, I won't kick off taxes, but because and that's evergreen. That's evergreen. But for interest rates, I was having this LinkedIn conversation this morning. So this person was giving me his pitch for why a 3 cap is a good buy in a high inflation environment, and this may not even be relevant to your question, but his pitch was, well, if you have 8% inflation, your gross income goes up 8%, your expenses go up 8%. We were talking in the context of multifamily, so your NOI goes up 8%. And my contention, my opinion is, right, okay, so your NOI has gone up 8%, and your the value of dollars have been inflated away by 8%. So you're at net zero there. And then he was like, well, but that increases the value from a cap rate perspective because you're calculating value based on NOI. And that's like, sure, if your 3% cap rate is static, but the reality is in an environment where the Fed is deciding to fight inflation by raising interest rates, that cap rate's going up. So if your cap rate goes from 3 to 4.5%, that's a 50% increase in cap rate, and that's a 50% decrease in value, which is like super immaterial relative to the like riding the inflation wave on the income and expenses.
It's like doubling down, like on you got extra money on the poker table, or you got extra money on the craps table. You back up your bet at a 3 cap because you have to. What else are you going to do with all those chips laying on the side? Now, what do you do when all that money gets wiped off the table because you have a bad roll? I think, if anything, the last couple of years has really shown us that no one knows what's going to happen in the future. 3 years ago, if I was talking to you about 8.5% inflation and 8 interest rate rises in the next 12 months, you'd look at me like I was crazy. Much less talk about like a pandemic and a European war. So I just feel like when you're putting your next dollar somewhere, things like your triple net lease and your 3% or your 3 cap just don't make as much sense as they did in a much more steady, market where, having something very middle of the road that's going to continue with, predictable market forces. That's a great investment. Just when there's more of a variety, I think the smart money is looking to pivot and take advantage of opportunities where you can find things that are mispriced because people haven't caught up with some of the underlying fundamentals.
Yeah, I think that a 3 cap can always be good, or a 1 cap or a no cap if there's a value add component, right? Like when you're buying land to build, there's no cap, there's no income. So you can't really look at it in a vacuum. There's a lot of context that has to be contemplated there. It was just a weird conversation. Brandon, what have you been seeing as far like how have you been seeing these like short term hikes in interest rates and the kind of like so the 10-year treasuries responded, and have you seen that manifest itself in agency finance since you're doing a lot of multifamily Fannie and Freddie?
Yeah, real quick, just touching on like the cap rates. I mean, yeah, obviously a 3 cap rate deal is not something most people want to invest in because it's going to require a lot more equity into the deal. But I mean, hey, if you have a couple $1 million sitting at a 1031 or something ready to dump in any property you see, then I mean, it can be a good investment. As far as agency stuff, I mean, if you follow the treasuries at all, the treasuries have gone up, I think, almost a whole percent in the last 30 days alone, which is disgusting to think about. But yeah, I mean, agency rates are probably the highest they've been in the past 5-6 years, maybe. So, I mean, the problem is that not only the treasuries are going up, but so are spreads from Fannie and Freddie. So they're getting double hit, and eventually they're going to have to start dropping their spreads more to, I mean, still remain competitive in the market. Because one of the things with Fannie and Freddie is that they've always been more attractive in terms of interest rates compared to like local banks or credit unions or CMBS financing. And that may not be the case now, depending on the deal. But they've also kind of incentivized affordability on properties now. So if you have a property with like a high concentration of like affordable tenants, then they're definitely leaning in and getting more favorable on those.
I think lower leverage, you touched on this. Lower leverage is kind of a byproduct of increased rates, right? Rate goes up, debt service coverage ratio gets hit, and therefore leverage gets hit. So Fannie and Freddie, who have been, amazing for high leverage, long-term fixed rate, non-recourse financing, not only have been less competitive from an interest rate perspective, but now they're less competitive from a leverage perspective. So even though you can get up to 80% LTV on an apartment building, like there's no way to get it anymore. They're coming in at 75, 70 and below. And leverage was always kind of a net positive thing, right? You borrow at 3%, you buy a 4 cap or a 5 cap or a 6 cap, you borrow at 4, you buy a 6, and you've got this positive spread. And now in some cases the spread is negative. I'm buying a 4.5 cap, but I'm borrowing at 5%. This is a kind of an inverted dynamic. It'll be interesting to see how it all plays out.
It's playing out over on the small business side as well. If there's anyone out there who looks at small business loans, the SBA has 2 programs. You have your 7A and your 504. 7A rates haven't changed too much yet. They're generally tied to prime, which is only up a quarter point. But the 504 is this program that's directly administered by the SBA, where a second lien is placed behind a first lien from a conventional lender. So, this rate has always been below market. It's been a way for small business owners to get up to like a 90% loan to value, purchasing fixed assets like real estate with a below market rate. The beginning of this year, the 504 rate was 3.21%. I saw yesterday, Blake, the 504 rates just came out, 4.676%, up 1.4% in just a quarter. That's something that's like really materially going to affect what people can afford. These new higher payments, when we're looking at the DSCR calculations on the back end, it's sort of like these small business owners are getting hit with a double whammy, where you have 20, 21, 22 that all had drags on. A lot of these companies had drags on their income, so their tax returns and historic cash flows look weak. And now looking forward, trying to purchase property, you're now having to cover a higher debt payment. I can't imagine that that's going to have a strong effect on assets. But if the Fed's out there right now deciding to declare war on demand, you increase interest rates to help reduce demand because you can't really do much about supply in the short term. It's a tough situation out there for some people.
We run the risk of getting too macro and talking about and going into the dark sciences of like what's the second order consequences of these rates going up on like the greater market, where as like this like junk bond market gets close to maturing, and people can't refinance their $1 billion unsecured subordinate financing because the rates are 3 times higher. It'll hit people with floating rates too. Steve just pinged me. He said, "Don't forget to have fun," which is interesting because we had so much fun coming into the stream, and then as soon as it hit, things got deadly serious. But I'm not sure how to force fun into the conversation because we're talking.
I think Joe can do that. I think Joe's pretty good at this.
Yeah, we just need to go back to the Family Guy jokes that we were talking about before.
That might be inappropriate. Would
What's
you leave a dance
inappropriate
party?
though?
Yeah,
I definitely would not.
Everything. We're streaming live, and we probably have to.
This can be like an NC-17 like podcast or a stream. It doesn't have to be like PG.
Did we check those disclaimer boxes?
I think we've already been banned from YouTube. I'm sorry.
We've already. We're not getting monetized on YouTube right now. That's too bad.
Unfortunately, not.
I was really banking on that as our next cash flow stream.
Yeah, and you can't give me too much crap for always going macro, Blake. That was what my degree is in, and now I keep getting like sucked down these rabbit holes of interesting articles.
Ray Dalio, you go down the Ray Dalio rabbit hole.
Oh my god,
Ray Dalio makes me feel so smart. No, because this dude's so smart, and he writes incredible. He takes very complex subjects, makes them simple, and I could read them, and then I could regurgitate them, and I look like the smartest guy in the room. I'm like, oh yeah, we're at the tail end of a long debt cycle here. So yeah,
the Bretton Woods dollar and long-term debt cycles. His last article, I think, was like we're in the first round of the battle for the future of the reserve currency. I mean, if that doesn't get translated, I don't know what does.
Ray also thinks we're gonna have a physical civil war soon too. So I hope he's wrong about that.
He's watching right now.
What happens if there's no shot? There's no shot. If there is a physical civil war, and now we're way off topic, interest rates go back down, right? But inflation.
So it sounds like that's the resolution here. We need a civil war. How can we make that happen?
I'm not taking this. I'm not going political, but and I'm pretty sure that's not the answer. Okay, more on interest rates, or there's a more exciting topic, taxes. So where do we go?
I know it's hard to pick, isn't it?
Where do we go? There's so much juice here. Who wants to lead tax conversation, or who has something to add on the interest rate side, or if anybody has any comments or questions? And where are we? We're on YouTube, LinkedIn. Are we on Tinder or TikTok, or is that
YouTube, LinkedIn, and Twitter?
We're on Roblox. I think we're in Second Life. Definitely on the metaverse.
Well, then we should be making a lot of money. Should we talk about the effect of interest rates on real estate prices in the metaverse?
Now, there's a wild topic.
It's a real topic, one that
I know it is. I know.
But I don't believe that anybody's really qualified to talk about it, except maybe Zuck.
To me, it doesn't even make sense on a fundamental level. Real estate has value because it's a discrete resource, right? If I own it, Jeff can't own it. It's a one-to-one.
That's an NFT. What? That's an NFT.
But
so
you can always make another NFT. I can't decide, I'm just going to add a block, or I'm going to add a lot to my block here in Philadelphia. Location. That scarcity derives value. That's basic econ. How are these things trading for millions of dollars when they are artificially scarce?
Well, they're tulips in one regard, right? But somebody smarter than me will tell me why it's not tulips. So so to answer your question, I think we're way off topic, but I love Yuval Noah Harari in *Sapiens*. He tells this story about how like everything's make believe and fictional. So like, what makes a dollar worth something? Candidly, like what is more fungible and fake manufactured than U.S. dollars? There's like a machine in like a dark room somewhere that's printing out gazillions of these a second. So I don't know what's the difference between a piece of real estate in the metaverse and a U.S. dollar. It's the trust and the belief in its value that people have in it. So if enough people believe that your metaverse real estate is valuable, well, then it's valuable. I can't believe it. It's whatever. It's a handicap of mine. Didn't expect things to go that way.
Well, I'm glad I'm not the only one who like it. Like it's just I know it could be a sort of a Luddite outlook, but I understand the value of indelible blockchain. I just feel like right now it's a technology that's looking for an implementation, and there's just so much money sitting on balance sheets that these Web 2 and like these legacy companies they've been built and dominated their industries based off growth models, and now you sort of hit saturation. I think Facebook lost users for the first time ever last quarter. So the way I've heard it explained is they're trying to create that additional demand, try to create artificial growth by creating an artificial world. It's, brilliant if you can pull it off, but it's just hard to vision.
I'm super I don't own any NFTs. If I own a few $100s of crypto, it's just for me to figure out how like some of these tools work. So maybe I'm a complete knucklehead. But like the reality is like the value of a lot of these things has gone up a lot because people appreciate it, and the value of US dollars has gone down by 8% year over year, right? So people believe less in the value of 8% less in the value of dollars. But one way to preserve your dollars is to invest in commercial real estate, and then do a cost seg study in order to accelerate depreciation and write off your ordinary income. So, should we do that? I don't know. And that's like, for me, that's not. It's a hell of a segue. For me, that's like that's like one of the most significant benefits of commercial real estate that isn't really contemplated like in the model, right? When people are modeling IRRs and prefs and distributions and stuff, like the real big thing to me is especially if you're in a high tax bracket, if you're accelerating depreciation and you get a massive write-off. If you own enough commercial real estate, you don't have to pay income taxes, and that's pretty cool. Anybody want to riff on that, or do you want to talk about the invisible sculpture and the shredded painting and NFTs?
No, I think that there's it is tax day. It is an unfortunate time where we're all sort of looking back to see what we did last year. Hopefully some people got it done earlier than I did. I'm going to be on extension for the first time this year, trying to figure out a couple things. But, one of the things I wanted to talk about is something that I learned about. There's a tax credit that was passed for employers that is available. It basically is a refund for payroll tax credits for people who have below 500 employees over 21. It was a way to help stimulate small businesses through like an indirect payment. It is something that
another way to I don't want to get political. I'm sorry for cutting off, but another way to inflate away the value of dollars. I was talking to somebody the other day, and he was like, how do you fight inflation? I'm like, well, you raise interest rate, or you raise taxes. He's like, raise taxes, can't do that. Well, you're already paying a gross 8% tax on your income and assets right now. You're paying it. And a lot of these like stimulus things, which I think were like really needed at a very like stressful and scary time. And I don't say I know what the policy should have been. I think our policymakers did some things well, some things poorly. I'm under the circumstances. But man, like so much stimmy. There's I don't know. It's like it's a terrible analogy. Sorry for interrupting. I'm muting myself.
No. I actually had a question. I just wanted to throw over to Jeff. I'm not sure if people know, but Jeff's actually in Romania. Is there a tax day over there? Do you actually have like to file as part of being a citizen?
So this
every day is tax day
pretty,
in Romania.
so this is pretty interesting, right? In Romania, unless you are self-employed or employed as like an independent contractor, your employer is obliged to file taxes on your behalf. So you don't actually touch your taxes, basically. But at the same time, you don't really see what's being taken out, because if you did, oh my God, you just have a heart attack and drop dead, because it's something like 45%, and we don't have anything to show for it. So it's interesting, but yeah, there's no tax day. Although, as an American citizen, I do still have the privilege of filing taxes in the U.S. despite not living there. So, but because I'm outside the U.S., I get a 2-month extension, so I have to file by mid-June. So I've got a little bit of leeway at least.
What about I'm going to go off topic again because I don't know how long I want to. I might get my eyes glazed over as soon as I said taxes, which is weird because I was the one that was talking.
Go for it. We can take this any direction we want to.
Are we seeing any improvements or what's the opposite of an improvement?
Deterioration.
Oh, jinx. Is that? Do I win something? Do I get a prize? Do you get a prize?
I think I do.
You get to file Jeff's taxes for him.
As long as I don't have to pay him. How has the supply chain situation evolved and impacted things like construction and property level expenses and stuff like that? Brandon, have you seen on T12s? It might be like really lagged, but have you seen like expenses rise kind of in concert with rents, or have you seen anything appear in T12s like on existing property as a function of the supply chain disaster that we have?
Yeah, I mean, I haven't personally, just because we usually make a pretty good habit of getting stuff out there. That's not like a reoccurring expense, and I think it's probably too soon to see that change. And obviously, there's so many different options out there for properties for like rehab, or what stage of rehab they're in, to probably see that difference. But I'm sure it'll happen sooner or later.
Yeah, I know I've seen it on construction projects where the cost has to be refactored like 3 times. I think Brad in our office he's working on we're going to close like some $20-30 million construction loan, and I'm pretty sure they had to refactor the total hard costs more than once.
Yeah, I'm sure that project probably cost half of what it costs now a couple of years ago.
Yeah. Oh yeah. But look, rents are 3 times higher where it is in East Boca. So I guess it's all relative. Dollars are
that's generous.
No, I'm making that up. I don't know.
No, that's generous. 3 times. I wish.
Oh, you're saying more.
Yeah.
I just saw that on a deal that I'm working on, assisted living facility, Blake. It's a 29-room facility. They're looking to add 30. They got the quote from the contractor stated, December 17th. It was $3.4 million. We got it updated at the end of March, $3.9 million. You're talking substantial increases to the cost, not just of material, but labor. And if you want to lock it down, that's just sort of what you have to pay top of the line. I think a lot of that, hey, this will be my second job, I'll come over afterwards. Those guys just aren't showing up right now, or they're getting paid so much to stay and focus on these bigger sites.
GCs have to. Oh, sorry. Go ahead.
No, that's it. Yeah.
GCs have to be getting wrecked, right? Like this has probably already happened, and it's old news. But GCs that were signing GMP, like guaranteed maximum price agreements with developers, like probably got absolutely destroyed. I wonder wonder the extent of the pain that's been felt in the GC industry, because they can't get subs, and they're signing agreements when material and labor costs have increased like fantastically, if that's even a word. A lot of pain there. Is that a word, Jeff? You're a senior editor. Fantastically was my context.
Fantastically, it was fantastically used. Yeah.
If you ever need me to look over any of your content, I'm only a
I'll
confidential.
shoot them right over to you. Yep.
Yeah, I put that right on my list of things that I'm not doing anytime soon. Okay, what else have we got that we wanted to touch on? We touched supply chain, we touched interest rates. No questions from the live stream, which is good news, because if somebody asks a tough question, I don't know that I'm qualified to answer it. We hit taxes, which was very exciting. Who else wants to introduce anything? Any interesting deal you've worked on? Or Jeff, you're actually probably the smartest guy in the room, right? Like,
oh man,
are there any stats?
I don't think so.
Are there any stats or interesting things that are coming up in your research as you're like, all day kind of in the weeds?
Well, one thing that kind of jumped to the forefront of my brain when you were mentioning when you're mentioning the supply chain issues is actually the positive demand dynamic that's created in industrial real estate. So you've got all of these ports backed up for miles, people waiting for months to offload their cargo. And so everyone wants to just grab on and hold on to as much inventory as they can. I mean, if you contrast that to pre-pandemic, when everyone was like just in time everything, it's such an interesting way that the dynamic has shifted. It makes sense. But now there's just like, you already had low vacancy across the sector. And now it's just like, I was reading a report today, the Inland Empire at the end of Q1 was down to 0.4% vacancy market-wide, which is just crazy. Insanity if you think about it. And they don't have that much land to build unless you go real far to the east. So yeah, I've just been seeing these industrial dynamics. I've been kind of in the weeds of industrial today. And that's been kind of weighing on my mind, is just like, how do things really get better? I mean, right now with industrial real estate, people are just like, well, screw LA, let's move to Phoenix or Las Vegas or, another metro where there is space. But, that demand is still there, and it's going to be a tough ask for somebody to pay like far over like maybe $2 per square foot of an industrial real estate in like suburban LA. You know what I mean?
It's a natural. It seems like a natural kind of move, right? So I'll just keep talking about inflation, even though that's not the topic today. But if I have warehouse space, would I rather have dollars or toilet paper? I'm loading up on TP, and hopefully it's that Charmin Ultra, whatever, not what they serve us up in this building, which I really need to talk to management. But as the value of your of their dollars decrease, the price of the goods, right, of those goods increase. So it's maybe we should all be buying paper products instead. I wonder if there's any good financing mechanisms for paper plates. Probably is. Joe would probably know that better than I.
Actually, if you look at it, there's two schools of thought.
Tell me, what about an NFT of a paper plate? That's the future. I've long paper plate NFTs.
You buy them from NFT Walmart.
Right.
Actually, I did have one question. I know we're up against it here. A little behind the scenes, Janover Ventures moved into its shiny new headquarters. And it seems like from our Slack chat, ping pong has taken over the office. Who down there is the champion right now? Who's got the best game?
This is highly irrelevant, but I'll lean into this. So I think Rippey, Brian Rippey, associate capital markets, is the best. But our on the data side, our data engineer Gustavo Lemos approached me yesterday or 2 days ago and told me that it's his opinion that he has the most God-given talent at the table. This is a true story. And he took me to the side and he said, listen, I think that I have the most innate talent here at this. So, and then there's me who I would say I'm just about the worst, but I'm the most competitive perhaps. So I want to play everybody, and
you've got the
Blake's the guy
highest
you
growth
play before you leave
potential.
the office.
I have the lowest base rate, the highest growth potential. We're up on time, everybody. If you want to get into a good game of ping pong, I'm not your guy, but there are people in our office. We're in East Boca. You could just you can shoot us an email, visit us online, janover.ventures. It's been real. Thank you very much.
Thanks very much, everybody.